We have been working in this project called ViPES2X, the AI-driven virtual power plant for energy storage and power-to-X systems. It's a project that's funded by EUDP, and we're very glad for the funding. We have been working together with the DTU Wind, DTU Energy, and Live from France, as well as Imperial College London from England. And today there will be a presentation from all these companies, as well as our own Greentech presentation. The program is as follows. We have 20-minute speeches from all those presenting. We might have had somebody at 10:40, but that did not come as speaker. So instead, we'll move the speakers up one slot, and at 11:40, we will then have a panel. So if you have any questions, then you can save them for the panel, or if the speakers are done before 20 minutes, you might have a chance for 1 or 2 questions.
Okay, so I'll just give a quick introduction to who we are and what we're doing, and then talk about this virtual power plant, this platform we built that's in operation today, and then talk a little bit about where is the money buried when you are having a battery and want to operate it in Denmark, and then go into a little bit of energy market development and talk about cannibalization and how the increase of PV is making the price volatility increase, which is very good for the batteries. Yeah, so first, Greentech is a group of nerds, some people would say, that is very focused on battery degradation and energy markets. So I fit in those categories. And we built this platform that is built around optimizing earnings on a lifetime basis. So where we optimize considering the degradation of the assets. Then we've been trading in the different markets in Denmark for a couple of years. And then kind of the business have developed and expanded. We get a lot of requests for doing business cases and the financial kind of background for taking investment decisions in large-scale batteries. So we have done a lot of those kind of studies for actually most of the large batteries you're seeing it that are being installed in the moment in Denmark. Then the last part of our business is to manage the building project and getting all of the approvals, because that's something we also experienced is very difficult. And often these projects get 1 or 2 years delayed. So we kind of have these 3 legs in the business, such that we can take the whole chain from the decision and until we go live. Yeah. Okay. So this is kind of the components in the virtual power plant. The core is the EMS, the energy management system, which is a mathematical optimization model that takes all of the different forecasts and constraints and so on into account and decides what is the optimal allocation in the different markets. Yeah, and then executes it in the trading system and send it to the controller, which makes sure that it's delivered by the assets. So one thing that is super important is that we always do the optimization on an asset level. We don't do global optimization to optimize the social welfare of the entire portfolio, because our basically each asset will have a different cost base. They have different tariffs, different efficiencies, different standby consumption, also local differences in production and consumption. And therefore, the optimal plan that will maximize the profit for one asset is not going to be the same as the plan for another asset. And then also, of course, the customers don't want to sacrifice their earnings to benefit other customers' assets as well. So that's also important. But then everything is pooled when it's traded in the markets, because then you often need bigger volumes and you have some minimum requirements and so on to trade. So that's, you could say, is where the virtual power plant comes in, that everything is aggregated and pooled into a bigger volumes. Yes. Then we have separated the markets which are auction-based when we do the allocation, we say, I want this volume in this market, then it's sent to the auction, executed, and then the results are coming back and distributed to the assets. But then Intraday Continuous is built as a separate system because it's more like a stock market. It's pay as bid and it's continuous transactions all the time. So there we also have an optimization running on an asset level, but it's running much faster. While the capacity planner here will run every 5 minutes, and the Intraday optimizer will run every second or something like that. Yes. This is just to say that there needs to be a balance between production and consumption every second. And therefore, Energinet has this toolbox, and you probably know, but I just want to mention that there's a lot of different markets that you can provide and sell your flexibility in. There is if you take from left to right, the fast and energy light reserves, and then moving towards the heavier and more bulk energy delivery reserves. Generally, it's more nice for a battery to deliver fast reserves with low energy because they have a limited energy. But the battery is actually moving more to the left as well, and also going into the AFR market and the MFR market. So if you take a look at the system we have in operation today, there's a lot of decisions we need to make all the time. 24 hours before the day of operation, you can see all the way over here, we need to have a forecast of the spot price and then of the price of each of the different markets, but also a forecast of the cost associated of delivering the services of each market. Because there's also a big difference in that, in the amount of activation and cost of tariffs and so on. So then we basically need to take all decisions over here. Then we can bid it in the primary reserves markets past midnight. But otherwise, we have taken holding capacity back such that we can bid it in the AFR, MFR market in the morning, or holding it even longer and selling it in the day-ahead market. Then sometimes some forecasts change, especially if we have some EV portfolios. There we often sell a bit extra because here at 6, we have the second auction for the primary reserves. And then we are closer and we'll have a better forecast at that point. And also we know what the spot price is. Then after the day-ahead market is closed, we also can move into the intraday market. If we have allocated free capacity, very often we sold everything and then we don't have any flexibility to trade. But if we allocate free capacity, then we can keep moving around our positions in the intraday market. If another hour becomes the cheapest hour, then we will move our charging position to that. Or another hour is becoming the most expensive, then we will buy back our sell position and then sell in that hour instead. And then all the way, we can do that all the way until 1 hour before the delivery hour. And actually all the way to 25 minutes before the delivery quarter, we can also make an energy activation market bid for AFR. So there basically, if you have a position, you need to charge a discharge, then we can say to it again that if you're willing to pay more than that, then we can also not do that. Yes. So this is a picture of the kind of showing how complex it actually is becoming when you need to co-optimize energy and capacity markets. If you look like 1 year back, we would be doing FCAD every hour with all the capacity, and we would have a state of charge of 50% because we would sell FCD up and down all the time. And that would be the optimal solution. But now, during last summer, the FCD markets decreased and then FCN. And now, in the same period, we had spot price fluctuations increasing. So that means that the co-optimization went from being not relevant to being quite relevant. So what you're looking at here is 4 days of operation of a 1 megawatt battery. And in the top, you can see the power allocations. Then you have the state of charge, is the red line. And then the dashed yellow and blue areas is the energy reservations we need to make in the battery to comply with the regulation for delivering the frequency regulation services. Then in the third plot, you have the spot price and the service prices. And the spot price is much more volatile than the services. So when you do energy trading, it's quite simple. You charge when it's at the minimum price and you discharge when it's the highest price. And usually on average, you earn around 100 euros per trade, per cycle. But the problem is that you only have one or two of these cycles per day, while the advantage of all the capacity markets is that you get those earnings every hour. So it's a more continuous income, and the spot is not frequent enough to be really great for the battery. But you can actually combine those two. The problem is that to charge, like from a low spot price here, you need your state of charge to be close to minimum and then grow up to a high level by filling up the battery. But then the optimization shows here that you don't fully charge it to 100%. You make sure only to charge to 80%, so you still have 20 minutes. So you can do FCD up and down in all the intermediate hours before the next spot price event. And then if there is sufficiently long time between the high and low prices, then it will actually try to keep the state of charge in the middle, because then you can do FCN instead, because FCN has a much bigger energy reservation. Yeah, so it's the combination of all these kind of revenue streams that gives the best income. So what you can see here in the bottom is how the value in the operational profit is growing throughout the 4 days. And you can see that it's kind of gradually, slowly increasing from all the capacity availability payment. But then every time there's a higher spot price, then you get a boost, because then you sell everything you have in the battery, or most of it. And that way you can kind of combine these two. Yes. So if you look at the capacity market, there's one trend that has been very clear, and that is there's been coming more and more of these markets throughout the last couple of years. And every time there's a new market, it's often faster requirements, and there is no one that can provide it. And we have super high prices for a while, and then everyone installed batteries, and then the prices drop because it's marginally priced. And that's basically what you could see here last summer, or after around September, that all the prices here collapsed and then went from 50 euro per megawatt per hour to 1 or 2 euros per megawatt per hour. And that is when the spot price was becoming relevant. But then luckily, we have this opposite trend of the spot price earnings growing because of all of the renewables coming in. And then the last crazy thing that happened last year was the AFR market, which was completely changed, and therefore also had super high prices because all the old actors were too slow to be in the market. And then that just again became a super dominant revenue stream. So if we look at the optimal operational earnings of a battery last year, this calculation is showing our result of our optimization, that the one that is in production with forecasted prices and no perfect foresight, and taking into consideration also losses and standby consumption and tariffs and everything. So it's very close to what you would earn with a battery. Yeah, you can see FCD was what you did all the time. Then that collapsed, and then FCRN was what you would do all the time. And then we had this sweet, nice period where energy trading became super important, and that would have continued to grow if we didn't, if we didn't have this AFR thing coming in. And that's of course also great because then if you look at the last 5 years, we have had like an average payback time of 1 year, like every year. And now it looks like with AFR, we are back to that situation again, which is of course also not stable with all, because it attracts a lot of assets. But yeah, so before AFR, we were down to a payback time of maybe 4 or 5 years. So that's also kind of okay. And in DK1, they don't have the same amount of markets, but actually we're also doing fine before, but even more now. The money you see here from AFR is not just the capacity market, because AFR and MFR are different in the sense that you don't just get the availability payment. You also get paid for the energy activation. So you say, I have a 1 megawatt hour battery. I can offer my 1 megawatt hour at 500 euros per megawatt hour or something like that. And for example, if you take 500, then you see here during 1 day in February, you would have been activated and you would have received an average of 2,000 euros per megawatt hour, because they take the cheapest units first, but everyone gets the same as the most expensive unit. So you see how small the fluctuations are in the day-ahead market compared to when the Energinet suddenly needs extra energy or reduction of energy, then those fluctuations are significantly higher. So therefore, at least 2/3 currently is coming from energy activation, the energy delivery, and not from the capacity payment. So that's also kind of a new world we are in now. Good. Then talking a little bit about renewables and spot prices. This is the spot price 1 week ago, or 2 weeks ago. And you can see there is a very big correlation between low prices and solar generation. And that's even though it's from mid-February where there is not that much sun. But this is basically the reason that energy trading is becoming a key revenue driver for batteries and are actually starting to be a revenue source that can pay back the battery in itself. And that is that now we went from having one low price at night and a high price at day to having 2 low and 2 high every day. So now instead of doing 1 charge cycle, we can do 2 charge cycles per day. The spreads are more or less the same, but the earnings are twice as high. And that is even though, as I said, this is February and it's a very tiny amount of the consumption that we're actually covering here in this case. So yeah, it's just showing where we're going. And if you look a little bit back, you see this capture rate, which is the earnings that the solar is receiving compared to the average price of the month. And that used to be higher than 100% because the prices were generally higher at day than at night. But that trend is rapidly going downwards. With every megawatt of PV that is coming online, the prices are going to drop even further. And that's of course not great for the solar, but it's really great for the batteries. One of the main reasons that this is not great for solar is that they are all financed by something called power purchase agreement, which is a fixed price agreement for pay as produced, where the solar will get a fixed price for whatever it produces. And that used to be great for an industrial customer. Say, oh, I know I have a fixed price. It may be not the cheapest, but at least it's not going to be super expensive. But now they can also see this, and now they see, okay, when I have a fixed price, the real price is going to be lower, and when I don't have the fixed price, it's going to be much higher. So it's not really working as a price hedge anymore. Yeah. Then there are also a lot of other reasons why solar parks are in trouble. Like some are also trying to give fixed price all 24 hours per day. That is even more terrible for them. But I'm quite sure, as you already can see here from February, and it's even worse now in March, that this curve is just going to accelerate. So yeah, if you then look also here, it's also quite clear that if you can just shift your production 1 hour before or 1 hour later, that is incredibly valuable. And that is why I don't think that standalone PV is going to be a thing much longer, but instead co-located PV and BESS is going to be growing a lot. Yeah, and the solution is basically co-locate PV and BESS. And there is a huge advantage for the PV. You can shift the production to when it actually is valuable to have some production. But it's also, and then you reduce your curtailment risk because you can basically charge it for free to your battery instead of curtailing it when the prices are negative. But from the battery perspective, it's also much better than being standalone because you're saving, on average on a charge cycle, you're saving 24 euros per megawatt hour. So that means that you can do a lot more cycles. There are a lot more charge cycles where the spread is actually profitable to do a cycle. And all the ones you're doing, you're earning much more from them. Then you also have a lower capex because you have the land and you don't have to pay all the grid connections. Yeah. So what this is showing what if you co-locate your PV with batteries of different sizes, and you can see that basically more energy is improving your average price for what you export significantly, but that also increases your cost. But even a pretty small battery with your PV will actually improve your capture rate quite a lot. Yeah. Then my final point I would say is that you should not only see a battery. If you own PV, you should not only see the battery as an investment in itself. You should more see it like an insurance, because in an expected case, it's gonna be a good payback time. But in a stress test where you have zero capacity markets, everything is saturated, your capture rate is even lower than today, then it's actually going to be able to not only save itself, but also save the entire PV park, because with an even lower capture rate, it's even worse for the PV, but it's better for the BESS, basically. Yes. So to wrap up, just in time, it's very important that you use all markets when you are trading a battery. Otherwise, yeah, they will all contribute to an improved profitability. Yeah, pay as produced PPAs are probably a dead thing for standalone PV. Yeah, batteries are still in the current market, and also even if you remove AFR, they still have a pretty good payback time, quite a good return on the investment. Yeah, and then as I said, it's more, you should more see it like an insurance and a capture rate hedge for your PV park. So therefore, these two assets as an asset class really work well together, because when it's going worse for one, it's going better for the other. Yes, thank you.
Thank you, Andreas, and sorry for the stress. I think we'll take one question for Andreas, because maybe he will not stay here. So please go ahead, Louise.
Yes, so I was wondering, now with the market shifting all the time, you had FCRD, now you have AFR with other requirements in terms of capacity and all those things. So how do you navigate that also when you do the business cases, when you make the recommendations, because the world changes so quickly, the markets change so quickly. So it's one thing that was optimal yesterday is not optimal tomorrow.
Yeah, good question. Usually when we do a business case for a large developer, then we look at different scenarios. And we always discount the capacity markets a lot and say we expect them to go down quite fast, but we expect the earnings from the day-ahead market to increase, and also from the intraday. Then also now we're moving into we are getting the 15-minute market, and that is also going to increase our value a lot for the energy trading. We sometimes buy data from some third parties about the build out of renewables and conventional generation, and trying to make a 10-year forecast. But I would say it's very difficult to forecast. So probably what you can do best is to make kind of a stress test and say, what if all this is gone? Can you still just at least pay it back? And that is usually what you need to give a feel of confidence to the ones taking the decision, and also the bank, basically, if they are going to finance part of it.
Yes.
Generally, banks don't believe in capacity markets. They always set them to zero.
Thank you very much. And now we should have had Yannick Heiser to present, but he unfortunately got the flu. So today we have Professor Jalal to present for us. Please help me welcome Professor Jalal.
Thank you. Yeah, first of all, thanks Juan and Lesia for organizing the event, and thank you all of you for coming. It's really nice to see you, and also people online. I saw there are like 20 people online. Thank you so much. And yeah, it's unfortunate that Yannick is sick today, so he asked me to present. So I hope I can represent well what Yannick wants. Good. So today I'm going to talk about trading strategy, a bit aligned with what Francois and Andreas said. Let me see how it works. Yes. So it's about hybrid wind electrolyzer plants. So when you talk about hybrid plants, when I talk, it's about a combination of wind farms and electrolyzers. Of course, you can add more assets there. It will make the problem more complex. You can add storage. You can add, I don't know, hydrogen storage or batteries or whatever. And the idea is that how this asset can participate in multiple markets. And I can tell you that multi-market bidding strategy, even for us in academia, it's a tough problem. It's a very complicated decision-making problem. It can be very easily very complex. And here we are trying to use a data-driven approach, not because it's a fancy word, because we think it's the way to go. We think it's a more pragmatic solution for companies. And hope we'll be able to convince either Greentech or Live or other partners trying this. And it's really nice to see that in Francois' presentation, he already tries to do some data-driven or decision-focused learning. That's my personal opinion. I think that's a pragmatic solution compared to other methods. So let's say first about introduction. So we are section called EMA at DTU Wind. EMA stands for Energy Markets and Analytics. At the moment, we are 12 members, including me, 2 assistant professors. Both of them are used to be here. Alessia is there. Fazane, she's now in London. Alice is online. And also we have 6 PhD students. Jan is the one who did this work, but he's sick today. Marco was here, but used to be here. Anyway, Isaac is on the next step. So you will have a chance to meet some EMA members, maybe later in the panel time or even after the event. Good. This is the hybrid power plant, how we see that. As I said, wind farm and electrolyzer together, and it could be even combined with more assets, storage or whatever. And then they have a connection point to electricity grid. So there's one connection point. And yeah, so what is the goal? We like to earn money, highest money we can, under uncertainty. And then inputs are our forecast, whatever. And the output is bits, optimal bits that we like to place in different markets. And again, here, what markets we like to talk about? Now I can talk about that. So, Andreas told, but maybe I can a bit review. The first market every day you can see is what Andreas called capacity markets, or can call it ancillary service markets. In their markets around 7:30, E-1, you can go and place your bid for AFRR and MFRR markets. You can sell megawatt, not megawatt hour. Then by noon, E-1, a day before, you can place your bid in day. And until 2 p.m., there will be European solving the day at the market of the whole Europe, and you will get your bidding signal, how much you should produce, and you will see the market price. Then we have IPC and IBAs, right? That's what Andreas said. Intraday continues, starting in Denmark from 2 p.m. until hour before of the delivery. So if you are considering order group for tomorrow, 5 p.m., order group will be open until 4 p.m. And now we have 3 IBAs, intraday option-based delivery, right? At 3 p.m., 10 p.m., 10 a.m. The first one in D-1, the last one in day D. So why I'm saying this? Because there are a lot of markets you can place your bid, market bid. And then we have energy activation market, what Andreas said, right? So if you would like to bid for MFRR for activation until 25 minutes ahead of real time, you should submit your activation price to the TS. And then that's how we have imbalance. The imbalance price comes from your activation prices for MFRR and AFR. And I don't know if you heard or not, before Nordic TSOs, they used to pick MFRR sources manually, which one should be activated. From this fig, it become automatic. Now there are considerations of flow-based cost and whatever, and it made a bit of mess. So I was saying, as like the only LinkedIn post, I think he's a friend for many of us. So imbalance price yesterday in DK1, it went up to 5,000 euro. At DKK, euro per megawatt hour. Some interesting stories happen. So this means a good opportunity, right? Today, good opportunity to bid in that market. Good. So what more maybe you know already is that now Denmark is using single imbalance price, right? It used to be two price, but now it's single imbalance. It means that we can do gambling. It's a lot. So if you can forecast tomorrow, what will be the system imbalance? Market will be in short or long. You can bet, you can earn. You can buy in day ahead, you can sell in the real time or opposite. So, but before it was two prices, it means that you couldn't do arbitrage. You couldn't earn, but now you can. It's a one price scheme. I don't know how much you know about, but yeah. Good. So what Yannick wants to do is how to develop within a strategy. The idea of is PhD to add all markets, but we can't do all at the same time. So baby steps. So here today, I'm presenting you on the day-ahead market and balancing. Only two. Hopefully next time when you arrive here, Yannick is presenting and we added MFRR, AFRR market, and maybe also intraday market. Then it's a full functional market. So today it's just day-ahead and balancing market, how we can be in those markets. So that's the first. Second, as I said, it's a single price scheme. What does it mean? You forecast day-ahead price is 10 euro per megawatt hour. And you assume that the market will be short or long. For example, the balancing market price will be 15. It means that there will be a shortage. And then what happens? If you know that you have two options, 10 euro, 15, you are going to put everything in the second market. So that's why under single price scheme, you have all or nothing strategy. Either you put all capacity in one market or in the second market. But it's gamble, because you don't know which one you have a higher price. So that's why how we can avoid it. That's what Yannick tries to do, and how to optimally form a beta curve. Good. Epic math. So I told you that what we think is a good idea is data-driven learning. So what we do is that, I'll try to explain it in a simple way. Step one, optimization using historical. What happens? You have the data of the last 2 months. Data means how much realization we had, and what were the day-ahead prices, balancing prices, and so on. Everything historical data, which are uncertain in future, you know their realization impacts. For example, in the last 2 months. On the other hand, you have some information, something that we call features, that you have them in past, and also you are going to have it in future. For example, what? For example, your local wind forecast. You knew what your forecast was in past, and you know what, at the time of decision making, you know what your forecast is for tomorrow. Or for example, total wind forecast in DK1. That's what always energy publish. Or in Finland, right? So you have this kind of information. So what you can do is that you say in the training set, given all realizations and all information I have, I'm trying to understand, I try to find a policy, how to connect my optimal decision to the features I see. For example, a very simple naive example. You say, my day-ahead dispatch is 10% of my wind power forecast. What is 10%? 10% is something that you learn from historical data. Am I clear? And then you say that whenever I have my forecast in future, the 10% of that, it's what I'm going to place in the market as my pick. So you try to put yourself in past, learn how to connect your optimal decision to the features you have. For example, your wind forecast. You learn the dependencies like 10%, and you use it for the future. So you have step 2. Yeah, there are some mathematical there. Instead of saying my bit is 2 megawatt, you can do some nice mathematical things to make a curve, and then we do some feasibility restoration. Let me try to explain it. So, a bit of mathematics. So the objective function is maximizing the profit. So the first term is how much you can earn from day-ahead market. The second one is how much you can earn by selling hydrogen. And the third one is how much you can earn or you may lose in the balancing market. But these two constraints are linear policy constraints. So P day at PH is how much was your optimal bidding decisions. X are your features like wind forecast of energy or anything informative or ambient temperature. Q's are your policy that you are learning, like 10%, 20% of different features. Then you have power balance for your hybrid power plant. You have capacity constraints for your electrolyzer. And then you have electrolyzer efficiency constraint. And also maybe you have minimum demand. You say that, okay, over a day, I have to produce at least X kilogram hydrogen. So what I told you is that lambda day-ahead price, balancing price, and wind realization, they are uncertain. But for historical data, you know what they are. So given those true information, in the constraints 2 and 3, you try to learn cues, how to connect my decisions to features I see. And when you get cues, you can use that when you would like to place bid for the next time. Good. That's the main idea. But as I told you, under one price scheme, always you either bid full in day-ahead market or you either fully bid in the balancing. It's all or nothing. So what Yannick did, Yannick said, okay, let me constrain my gambling. I don't want to be a full gambler. So what he did is that he added some constraint to limit how much imbalances he wants to cause in the imbalanced market. So you can, for example, say that the maximum imbalance I like to cause in imbalanced market is 5 megawatt. That's one way. Or a bit more smart ways could be saying that the CVAR, the conditional value at risk of the imbalance, I would like to cause for 24 hours. Next step is not more than 10 megawatt, something like that. So you can try to constrain how much gambling you would like to do. By that, so the first one, the first line is the case that you don't restrict the amount of imbalance you cause, while in the third one that he called trading, you put how much imbalance maximum you can create in the balancing market. And then, yeah, here he learned from historical data, and then he placed bids based on that. I don't want to go in details, but eventually this model helps you to place a curve, saying that, for example, if for the first 5 megawatt for selling, I would like to place my bid at price 30, while in a buying mode, for the first 5, I'm willing to buy at price 20 or something like that. This is something that the trader learned from historical data. Good. About the performance, that's the final things I'd like to show you is that for this example, we did some analysis and we saw that by using this method, it's simple. Mathematically, it's simple. It's not stochastic decision making. You don't need to have a probabilistic forecasting. Then we saw that, just look at the first column. You could earn 85% of what if you could earn if you knew everything. Imagine if you were like a god, knowing what the prices, what exact wind will be tomorrow. Let's say that in that case, you could earn €1 by using our method without knowing what the future price will be. Here you earn 0.85 or 80 euros. So 85% of the profit, the maximum profit you could earn, which is good. But you can imagine if we add more markets, MFRR, AFRR, intraday, this will decrease. So we need to also at the same time complexify or make our model more advanced. That's why, for example, we have this young talent, is helping us to use a better models, not linear model, but maybe kernelized model to improve this 85% when we add more markets. Good. So the conclusion is that from data, historical data, as a trader, we can learn. We can use a pragmatic solution to learn how we depend our decisions to our features, like wind forecast and others, and then place our bets there. It's easy, it's interpretable, and it's a pragmatic solution. Yeah, that's all.
Thank you, Jalal. I think we'll take one question again. Yes.
Yeah, what, Clay? Good question. Yeah, but they're
It was great that you showed in the end, how much you can actually expect to earn as compared to.
right.
Exactly. But did you also compare how much you can yield in terms of profit compared to, state-of-the-art techniques? So how much more performance is this? And the other one, I forgot it, so I was curious when it comes to that.
Thanks, Claire. You should come as an examiner for Yannick's PhD in 2 years, because one of the other works that he should do while adding other markets is also benchmarking with other techniques, which is stochastic decision making. Then I'm afraid that it's not apple comparison. Maybe then we're comparing apple and orange. It depends how good we are in probabilistic forecasting, generating scenarios, developing stochastic decision making, and this. But whatever it is, it's complex. It's hard to convince hybrid Greentech or live to use that. That's a method, definitely a benchmark alternative we can use in academia. We are going to do that to act here, but it will not be straightforward for common students. No, we will do that. That's for sure. What I'm saying is that we are going to do that to see how good we are. But in terms of being pragmatic, this is definitely good. It's easier. Did I answer?
Thank you, Jalal. And then all the way from Imperial College London, we have Andrey Churkin, Research Associate in AI and Markets for Energy Markets. AI and Analytics, sorry.
A lot of AI.
A lot of AI. And thank you for this. It should work.
Hi, everyone. Good morning, and thank you for joining the session. My name is Andrey. I'm Research Associate at Imperial College London, and today I want to share our recent studies on intraday continuous markets. And specifically, we will focus on battery energy storage systems and real data that we got from Denmark DK1. So be ready for many complex and beautiful figures with a lot of price volatility. Just a few words about myself. As I said, I'm now working at Imperial College London with Professor Pierre Pinson. And before that, I was doing a postdoctoral research. I was working as a researcher at the University of Manchester. And before coming to the UK, I did my PhD in Moscow, Russia. Over the last years, I have been developing different optimization models for power systems and electricity markets. For example, in Manchester, we developed some interesting models for aggregated flexibility analysis in distribution networks. And if you're interested in these topics, please feel free to contact me. And also, I'm developing my YouTube channel. So if you want, please feel free to join it. And you may follow my recent studies. I also publish some general thoughts and things about academia. All right, let's talk about intraday markets. And first, I would like to start with some basics, because even analyzing and visualizing intraday markets is not easy. And as a motivation on the right, I show you a picture of a medium-sized battery storage system. You can see only 2 containers here, so maybe the total energy of this project is about 2 megawatt hours, maybe a bit more. And I want to say this bold statement that battery storage doesn't produce electricity. So the only thing it does, it stores energy and shifts it. So imagine you invest in this project, which may cost well above 1 million euros. How will you operate this battery to ensure profitability? And this is quite a difficult question because, again, we cannot simply produce electricity. So what we can do, we can participate in different markets. This was already mentioned today. There are many possible revenue streams for storage. Sometimes this is called revenue stacking. There are day-ahead markets, some frequency services, congestion management, balancing markets, and so on. And the only thing I will talk about today, the focus of our studies, is intraday continuous markets. And to get profit in this market, we need to perform arbitrage. This means that we need to buy electricity when the price is cheap. We need to charge our battery. Then we wait till high prices, and then we discharge our battery. Now, within this topic, there are so many research problems that we don't even have time to discuss all of them. We need a few hours. Researchers are applying different algorithms to analyze this problem. There are forecasting models, algorithmic trading, a lot of machine learning applications. I've seen papers where people use reinforcement learning to train trading agents. And today I want to focus on a very specific, interesting problem, which is called anomaly detection. So we will try to detect and analyze trading sessions with unusual, abnormal prices. And the goal, my goal for today's talk is simple. I will show you why detecting anomalies is important. And then I will share with you a very cool tool, very simple algorithm that you may want to use in all other data-driven studies. You may apply it to any data set. All right, so in this picture, I visualize how intraday market dynamics work. And the important thing is this right part. We can see 24 green hours. These are so-called delivery hours. So we are trading energy for 24 delivery hours for day N. And we are trading for these hours continuously. But an interesting thing, as you may see here, is that we start intraday markets on the previous day at 3 p.m. This means that the longest possible trading session is 31 hours, and the shortest possible session is 8 hours. And it is important to understand that we have these 24 sessions partially overlapping. We can say that we are trading in parallel in multiple sessions. And within each session, we have sellers and buyers, and they are submitting order to sell or buy electricity. Following trading terminology, economics terminology, we call the price for selling ask price and the price of buying bid price. And you can see, I show this by these two continuous curves, the blue and the red one, that we have continuous prices in each of these parallel 24 sessions. Continuous meaning that usually at each millisecond, you have some orders in the order book, and there exists a price for buying and a price for selling. So to make sure we understand why we have prices and why prices change all the time in continuous markets, I prepared this simple example with just 3 timestamps. And at each time, we have some orders, and we arrange them by their value. So let's take a look at these red orders. These are bid orders for buying electricity. And the best bid order has the price of 60 euros. This is the maximum price people are ready to pay right now for buying energy. And the best ask price, the best price for selling energy is 75 euros. So you can see now these two curves, and you may notice that there is a gap between the curves called bid-ask spread. This means that no trading is possible right now. The prices simply don't match. Then let's move to timestamp 2, maybe a few milliseconds later, maybe a few minutes later. Some market participants submit new best bid order with a higher price. Now it's 65 euros. And we see that there is a shift in the bid price and the price increased. But still there is a gap and no trading is happening because the prices for buying and selling do not match. And finally, at timestamp 3, we have new buy order, bid order with a high price, 80 euros, and it overlaps with the best ask price. This means that we can buy these 3 megawatts for 75 euros. We eliminate this order, it disappears from the order book, and all prices shift up. So you may notice the book is updated and the bid price goes up as well as the ask price. So this is what is happening when we have more and more orders for purchasing energy. As in the stock market, the price goes up. If we have more orders arriving for selling energy, the price may go down. This is the basic visualization. And in this project, we work with a real data set called Intraday Continuous Apex market for DK1 Denmark zone for 2023. And here is an example of just one trading session. In the whole year, we have 8,760 trading sessions. And in every trading session, this is happening. We can see the best bid price and the best ask price and how the trading is evolving. For example, in this case, we can see that at the beginning of the session, there was low volatility, not too much trading happening. And then closer to the end of the session, we have more and more trading. And I would say that in this particular session, the prices accelerated and the prices for buying electricity grew up quite significantly from 180 euros up to almost 270 euros. So this is just an example so you can feel how markets and particular sessions work. And one more key thing here is this black line. It is day-ahead price. As speakers discussed today, it is also important to know what was the day-ahead auction. And for these markets, this serves as a baseline for trading because all market participants, they see what was the day-ahead price and they can use it as a reference point. Now, this was just one trading session for 1 hour, but how can we visualize the whole trading day, 24 trading sessions in parallel? And we are developing this visualization for our project and papers, where our goal is to show all parallel sessions together to demonstrate if the trading day was normal or abnormal, if there was some anomalies. So what you see here is the black line, 24 day-ahead prices, and the red scatter plot corresponds to the latest intraday bid prices. So we can see how the markets concluded, what was the latest price for buying electricity. But what were the dynamics of in these intraday markets? And if we visualize all intraday sessions, it will look something like this. So I think it's an awful visualization because all sessions overlap, all these intraday dynamics overlap, and it's quite difficult to see what happened in the trading. Therefore, what we came up with is to use colors strategically. For example, for the early hours, we can say that these will be green hours, then midday trading blue, then pink and red. And I think it becomes quite possible now to analyze what was happening in this particular day, how the prices evolved. You may notice that in the evening hours, the trading had some price peaks, and I would say that the trading ended on a high note with a significant price increase. And in this manner, we were visualizing some trading sessions that are of interest. Now, that was about the fundamentals and visualization. Now, I want to tell you about one tool that we are developing for intraday markets. And this is a tool for detecting anomalies, specifically event-driven anomalies. You may notice familiar faces on this slide. So this is how this research started. We just found a LinkedIn post about recent failures in the Scandinavian power systems, for example, in Sweden. So we know the exact date and time of some failures where a few gigawatts of power were lost. And then we can confirm that this indeed happened by checking frequency data from Fingrid. And we know that something wrong happened to, let's say, Swedish power system, Finland power system, which are interconnected to Denmark. This means that if market participants in Denmark see these events, this may impact the trading. And now using our visualization tool, we can show this specific day. So with this vertical red dash line, I show the exact time of the failure. And that was a failure at the Forsmark Swedish power plant. I would argue that something happened to this intraday market in Denmark, because if you check the pink line, the evening trading sessions, they were trading as usual. But then a few hours later, after the failure, we see some disturbance, some significant increases in the prices. And then several hours later, the price dropped back again. So what was that? Maybe that was an event-driven anomaly. And power system failures are not the only anomalies that may impact trading in intraday markets. There are many more reasons why the price may be abnormal. For example, due to wind generation. In this complex, messy picture, you see the whole year of wind generation in Denmark, offshore generation and onshore. And I think you notice that this generation changes a lot. Sometimes we have almost 5-6 gigawatts, sometimes much less. And when analyzing such a data set, we can put a simple condition. Let's find 2 consecutive hours where the total wind generation changed a lot, let's say by 1 gigawatt. And as highlighted here in red, there were 4 events like this with a rapid change in wind generation. Then we can say, okay, but were there any events where wind generation changed by 500 megawatts within 1 hour? And maybe you'll be surprised there were 200 events like that. And then we can analyze such events and see if they caused any price anomalies or not. Here I zoom in into a specific week, and you can see that indeed at some day there was more than 1 gigawatt rapid shift in wind generation increase. And then several days later, the same behavior, but rapid drop in wind generation. And once we know the time of these events, we can analyze them one by one. And this is an example of an event where we had a significant drop in the wind generation. And I would say that this is a very interesting session, especially for storage, because it may present a lot of trading opportunities. You can see how volatile was the trading, a lot of differences in the day-ahead prices and intraday prices. And moreover, if we take a look at the end of this trading session, many intraday prices, they were above the day-ahead prices, which creates this imbalance. And also look at the numbers. If we charge our battery somewhere in the morning, we can charge it almost for free, for €0. And then we discharge it in the evening for €110. So very interesting, very opportunistic trading session for storage. And maybe this was caused by rapid shifts in our wind generation. But what I was showing you so far was just manual analysis. We found some LinkedIn posts, we found wind generation data, and we manually checked if prices were normal or abnormal. The question is, can we do this in a systematic manner? And we say in this project, yes, we can use the algorithm called isolation forest. So here I would like to ask you if anyone has heard about isolation forest. Yes, 2 people. Yesterday at the project meeting, no one heard. So 2 people is the progress. I want to show this algorithm because it's very simple. It's very powerful. It can be applied to any large high-dimensional data set, and you don't need to have any labeled data. So you just drop your data set into this algorithm, and it will show you some normal data points and anomalies. And I prepared a simple example to show you how the algorithm is working. So this is just a 2-dimensional data set with 150 points. And imagine our goal is to find anomalies. So I'm asking you, please show me the anomaly points. And as humans, we look at this picture and we see the center of the figure and we say, everything is in the center. It's probably normal. And anomalies should be somewhere further from the center. So maybe this top point or right point is an anomaly. So our intuition will be to compute some distances. But the isolation forest algorithm is working in another manner. It is not calculating any distances. Since it is called a forest, it has partitioning trees, and it simply randomly splits the data set. So imagine we randomly split this data set. Actually, funnily enough, the monitor is already split. So let's say we focus on the left part of this data set, And then we check, okay, we make this partitioning. Which part is larger? And then we focus on the larger part, and we discard what was with the less points. And then we keep doing this. And after a few iterations, we will find that there still exists some subset of data which we haven't explored yet, haven't partitioned yet. So maybe this will be the normal points. And anything that was discarded, partitioned many times, we can say that this is closer to anomalies. This is the result of the algorithm when I implemented it in Python. And you can see that indeed everything in the center is blue, meaning normal points, and everything with a negative score, anomaly score, they are anomalies. And here is the visualization of how the algorithm is working. So this is just one run of the algorithm. We start splitting our space completely randomly, vertically or horizontally. And then you can see that we have less and less remaining points. And then we stop and we say that these points, they are blue because we haven't touched them yet. And there are 2 points in red. We isolated them a lot. That's why probably they are anomalies. Now, we implemented this algorithm for real data set. And this is a picture of one trading session, but you cannot just drop this picture for the algorithm. It will not understand what to look for. So you need to engineer some features. And in this case, we show to the algorithm what was the trading number of the session length, mean prices, standard deviation of the prices, etc. So you can see here 9 parameters. And then we run the algorithm for 8,700 sessions, and we see this. So this is the result of the anomaly detection. And there exists, I would say, a big cloud of normal sessions. And there actually is some linear dependency between bid and ask price. But then many sessions, they fly away and they become classified as anomalies. And why we're doing this? Well, let's see one of the extreme anomalous trading sessions. This was the session that we found using the algorithm. You may notice how volatile the prices were. Again, at the beginning of the trading day, the prices were close to 0 or 50 euros. And then there was a huge spike, and we could have sold energy for almost 800 euros. So very interesting trading session for storage. We are not sure if this is event-driven or not. We checked the wind generation data set. The data set says that there was a low wind generation during that date, but we are not sure if this was event-driven or not. But anyway, we can find such very interesting opportunistic trading sessions for our storage. And this ugly picture shows the whole anomaly analysis for the year. So 365 days, and each day has 24 hours. So we can see where anomalies were happening. And if we zoom in, we can see something interesting, that trading sessions with anomalies sometimes happen in a sequence. For example, here in one day, there was evening, 4 or 5 anomalous trading sessions. And then the next day, again, something was wrong in the evening. So it is worth exploring this. My last slide with conclusions and questions. So why we're doing this? Why we're detecting anomalies? Because we believe that it will be useful for understanding data set, the prices that we have, and this will further help us to develop and adapt our trading strategies. And moreover, I showed you how we ran the algorithm once, but it can be run in a loop continuously. So if you have new data today, we can add this data to the isolation forest and ask it if it is an anomaly today or not. And if it is an anomalous session, then we need to adjust our trading strategies. There are many other open questions that we are targeting in this research. We are developing also a reinforcement learning algorithm for trading. And overall, we're trying to understand if all these strategies will be a game changer for battery storage profitability. Because on paper, this all sounds very promising. We can increase our profits by 40, 50%. But then in reality, all market participants will see the same data. They will find the same anomalies. They will train the same reinforcement learning agents, and maybe they will simply capture all existing opportunities. So this is a very interesting research question. Will AI change profits of battery or not? And one more thing, we are developing a GitHub repository called Intraday Power Analytics. I am putting some simple examples there and data sets, so please feel free to check it out if you're interested. and please contact me if you want to collaborate on this topic. Thank you very much.
Thank you, Andrey. I think we'll take one question again. If there is one. Otherwise, I'll shift to the next slide deck.
Yeah, one question. Yeah, we haven't done this yet, but I think it's a very important input. We can have a different trading strategy, some hyperparameters of what it does. If we are in a normal trading cycle, maybe it should be a little bit passive. But if we identify that it's anomaly right now, the price is becoming more and more volatile, we need to change our trading strategy. We need to change some parameters, trade more frequently, or wait for the high price. So this will be an important input for trading bonds.
Thank you, Andrey.
Thanks.
And so for the last presentation, we have Laura Hannemose Rieger, who has been working together with Rieger in DTU Energy. So please help me welcome Laura.
All right, hello everyone. Yeah, already said, but I'm Laura, and I'm gonna talk a bit about using AI for battery energy storage system degradation analysis, or rather prediction. So the first question I always try to answer in my presentations is, why do I want to do what I'm about to present? And in this case, why would I want to predict future degradation? The reason is that we've talked a lot today about using batteries optimally to sell and buy energy. And we focused a lot on the price for the energy. One other component is that my battery is also not going to last forever, as my phone battery can be witness to. So if we want to do this and consider all factors, we also want to consider how our charge and discharge affects our battery, because charging and discharging with different charging speeds and discharging speeds affects battery differently. It's not a super simple problem. So what we really want to do is we want to be able to predict degradation in the future if I have a plan for how I want to charge and discharge my battery, because we can use that to incorporate into our decision making how we should optimally sell and buy energy. What tasks do we want to do here? So for battery charge and discharge, you normally measure the speed in terms of the full capacity of the battery. So 1C means that I can charge or discharge my battery in 1 hour. For 2C, that means that I charge or discharge my battery in 30 minutes. That's essentially the speed with which I charge and discharge, and that heavily affects how the battery will degrade. So what we would like to be able to do is say, okay, I want to, in the future, for example, discharge this battery or charge this battery for 30 minutes with 1C, so up to 50%. Then I'm going to rest for 1 month because the prices are not that good. And then I want to discharge the battery for 15 minutes with 0.5C. How should we model this? First of all, we want to consider what do we have as input, what do we want to have as an output. So we're considering the blue arrow here as a black box or the blue box, representing our machine learning algorithm. And we consider as an input parameters that will affect the degradation of the battery heavily, and that we also have a slight chance of knowing in the future and right now. So we have as an input the temperature, the calendar aging time, and that is just the time in terms of days or years that my battery has been aged since I first started using it. I have the maximum state of charge in my current action, so that's the maximum, let's say 75% or 100% that my battery is charged. FEC, full equivalent cycles. That means basically how many charge and discharge cycles my battery has gone through up to now. The depth of discharge, DOD, so how far down do I go? Basically the opposite of the maximum state of charge. And finally, the charge speed or discharge speed that I want to treat my battery to. And as an output, I want to have the future capacity. So right now I also have the current capacity, and I want to basically predict how much this is going to affect my battery. And if I then also have the price of the battery, so how much I paid for it, or how much I'm going to pay for the future battery, I can then convert that into euros or krona and say how much that action has cost me in terms of battery. You have to make a few assumptions for that, because right now, as you can probably tell, it's a fairly high dimensional problem if I assume that all of these parameters also influence each other. So first of all, we want to say that degradation can be decomposed into different, into the harm of different actions, so that if I have the degradation based on the charge and the degradation based on this charge, those two can just be linearly added and don't influence each other. And the other one is that I can represent my current state and also my future state of the battery in one single number. That is not true because batteries can degrade in different ways. So it means that I really need to have some kind of digital twin of the battery representing really how it looks inside. But that is the best we can do, and it's also a reasonable assumption to make. I tried a few different algorithms, and the one I settled on to use for this was to use a neural network. A fairly simple one with 2 layers and just some standard augmentations, like for example Batchnom, and using the atom optimizer to train it. And the main reason is that neural network can model fairly complex relationships. And if you use a small enough one, you can also use a reasonable amount of data and still get a fairly okay result. We also have not only as an output the mean capacity, but we also have the standard deviation of the capacity. And the reason for that is because we made a few assumptions. So we can't say for certain that we know really with certainty how good we can represent and predict for the future. So we also want the machine learning algorithm to have some kind of way of representing the uncertainty it has over the output, so it can adjust our decisions based on that. That means that we also need to slightly adjust the training or the training loss, training objective we have, and we instead use the negative log likelihood as opposed to just using, I don't know, the L2 loss or something. I'm confused. Okay, there's set twice. All right, so I have the mean capacity and the standard capacity as an output. And now how would I translate this into really predicting in the future how this is going to degrade my battery? What I do is I have the mean capacity and standard capacity, and I use these two to parameterize a probability distribution. Here, just a standard normal distribution over the output, and then I sample from that. So my true output or my actual output is not the direct prediction of the neural network. It's a probability distribution from which I sample to get also a measure of uncertainty. Then I do that many times, for one by just sampling from one neural network many times, but also from having 5 different neural networks or any number of neural networks. So I can basically in the end have as a starting point, one starting point, and I have 50 different candidates. And then I sample each of those through the actions that I take so that I get many different outputs, which I can then decompose again into a probability distribution of the output. And what you can see here on the right is I have, for one, the normalized capacity on the y-axis, so basically degradation as it happens, and on the x-axis, I have the number of cycles it goes through. I have in the dotted orange line the true trajectory, so ideally I want to predict that as well as possible. And I have in the blue line what I predict is going to happen. What I also have is an uncertainty of the output shaded in blue. So what you can see that the prediction is not all that great right now. You can also see that the machine learning algorithm knows that and has given me some kind of uncertainty to indicate that I shouldn't rely all too much on this prediction. With any algorithm, I need some kind of data to train my algorithm on, otherwise it's not machine learning. What we use here is a standard data set that was published very recently in 2024. And the main draw is that it's both calendar aging and cycle aging. So they have one type of battery and they're treated in 2 different ways because batteries age also when you just let them rest in your cupboard. So you really want to also be able to measure what kind of degradation happens when I just let it rest there. And because it affects batteries differently, I can't just say, okay, take one data set that has calendar aging and one that has cycle aging and just combine them because it wouldn't be the same kind of battery. I have varying depths of discharge, so I don't just go full cycle each time, but it also have, for example, only discharging for 20% or only for discharging 10%. And that's also very nice because it's variability that I have in my data set and want to model. It's not the chemistry that we want to use, which is a bit of a problem, but it still means that we can model how well our algorithm works with predicting the degradation I have. And there's also no mixed use. So I only have cycle aging or calendar aging. I don't have both of them together. unless there was an error, because sometimes they also just let the batteries for cycle aging rest. So we can also use that in here. How well does it work? We had two models, one for cycle aging, one for calendar aging, with the algorithm that I just described. So a normal neural network with output for the capacity and an output for the standard deviation. And then we can just, for one, have some randomly picked results. So just taking some random batteries from the test set and see how well they do. And then we can also quantify, of course, and have a number and say, okay, by the end of life of the battery, we are off by on average 10% in the capacity. Yeah, we can see for one, if you look at those three here, that the uncertainty prediction seems to work fairly well. Because if you look at the basically gaps, so the thickness of the blue line compared to how off the two lines are from each other, you can see that it correlates pretty well. There's two batteries where the prediction does all right, and then one where it's very off. And it's also where the uncertainty is by far the highest. We want to quantify the uncertainty also in a different way. So we basically looked at if we bind the errors or the points that I have into different bins, or based on how high the uncertainty was, and then saw or looked at how big the mean error was in each of those bins. And we want to be able to have a for one, a monotonically increasing line, meaning that if the algorithm predicts more uncertainty, please, it should also have more error, and vice versa. And we also wanted to be able to correlate fairly well with the actual error. So we want ideally this line to be just straight and on the red dotted line. It's not quite there, but it works fairly well. So you have somewhat monotonically increasing error with increasing standard deviation. And you also have that aligns fairly well with the red dotted line. So we can say that our uncertainty prediction works fairly well with this data set. We also wanted to predict the calendar aging. So if I have batteries and just let them rest in the corner or in my cupboard or wherever, and how well can I predict the degradation based on that? And for one, we can see that we are far better at predicting the degradation because it's less uncertain what happens. As opposed to cycle aging. So it's only off 2% by the end of the experiment, which is roughly, I think, 1 or 2 years. But we can also see that the uncertainty prediction works worse here. Because when we compare, especially for the highest uncertainty, it can't really distinguish all that well between the highest 20% uncertainty and the highest 40% uncertainty. So comparing those two, or drawing a conclusion about how well the algorithm works right now, with the two kinds of aging we have, we can say that for the calendar aging prediction, the accuracy is far higher, because if you look at the error, it is much lower than for cycle aging, and vice versa. For the cycle aging, we have an accuracy that's a bit lower, but we also have an uncertainty that works far better. So we can either say, okay, we can predict with a lower error or with higher uncertainty, or vice versa. And in both cases, it works well enough that we can reasonably say we can get some information out of here. What do we want to do to be able to predict the degradation? Do we have any questions so far? Sometimes. Sure. For our task here, which is predicting the degradation based on an action, we want to not only say, okay, we have a complete cycle of charging, discharging. We also want to be able to decompose the effect into charge and discharge, because we sometimes say, okay, we want to charge for 20 minutes up to 80%, and then we want to rest, and then we want to discharge down to 5%, and then we want to go up again. So we really need to be able to say, okay, we can look at the effects of those two differently, effects of those separately. That is a big problem with state of health estimation. So here's the effect of on the capacity, because to measure the capacity, you really need a full cycle to be able to have an accurate measure. So without having a full cycle where you can see the full capacity, you can't really say what the effect is on the capacity. And we want to see what the effect is of a just charge and just discharge. So we want to make some simplifying assumption here and say that we can disentangle the effect on the battery by a full cycle, just linearly into the effect by the charge and by the discharge. And we also want to say that resting time does not impact. So resting between charge and discharge, vice versa, does not impact the degradation much. Yeah, and the numbers, then we can say, okay, we consider the effect of the charge to be, or we simulate a full cycle for both charge and discharge. And for the effect of charge, we say, okay, we are not only charging the battery, we're pretending we're charging, and then we're discharging with a default discharge rate. And that is just the lowest that we can have in our dataset, because that would mean that the effect is the lowest. So we have the effect of charge not only as the effect of charging in terms of degradation, but also the effect of discharging with a very low discharge rate. Then we also have discharge, and for that we consider that to be the delta between discharging with the lowest default discharging rate and the actual discharging rate that we have. So we add on slightly more to the charging and then subtract it again when we discharge. And that means we can decompose it into just having the effect of the charge and just having the effect of the discharge here. Coming to the end, or what we can have as a result of that, if we make those assumptions and have the data set, then we can say, okay, we can make a predictor of the future charge and discharge based on the actions that I take. So I can have just a Python model that I call the predictor, and then I have to set on my battery and say, okay, my current capacity is just 4.9, and that's the current age of the battery. So it's already been alive and charged and discharged for, what do I say here? Yeah, roughly 3 months. And I've charged and discharged for 120 full cycles. I've set the temperature fairly high because to be able to actually see some kind of degradation effect, you need to treat your battery badly. So here we have, say, we're doing this at 45 degrees, so we can actually have some kind of number change here. And then we just say, okay, predict me please the future state of health with the current battery state and also with an action that I take. So in this case, we want to charge the battery for 30 minutes with 1C. We can say, I've here added as a comment the future capacity of the battery. Then you want to rest for 1 month and just let it stand there because right now the price is too low or too high for me to really use the battery. And then afterwards, I can again see, okay, this battery has slightly degraded in terms of the capacity. And then I again can discharge the battery here. Yeah, and here on the right, you can then see that in numbers, or not in numbers, in visualization, basically saying, okay, if I just let the battery rest first, for the first 50 days, you can see that it degrades fairly slowly, but still somewhat. And then afterwards, I start charging, discharging, and that's when it really starts going down. So we can see that we can model the effect of charging and discharging and also calendar aging for one battery type. Yeah. Coming to the end, state of health prediction is non-trivial, and it gets more complicated the more you get to a realistic use case. There's a lot of data sets and papers out there on just predicting in the lab if I do a full charge and discharge and only have one parameter that I change. Unfortunately, that's not how we normally use our batteries. We need to make some kind of assumptions, and we also need data that actually model those complexities we have. Because we have always a large unknown space of things that we made as assumptions or just data and inputs that we don't have, it's really vital to also model the uncertainty. So we can know when we are in a territory where we can't say with certainty what's going to affect here. Ideally, we would like to be able to not have to make a model for each battery type and for each task. But being able to generalize our chemistries would require a lot more data that hopefully we can get in the future so that we can use one model or at least fine-tune one model without having to make this entire thing again for every use case that we have. And I think so. I'm at the end. So thank you for your attention.
I think we can start with one question for Laura before we invite the other speakers.
Yeah, I'm just curious on the third point, like how far off do you think we are before we get there? So we actually like sterilize the different cell chemistries, and also will you be able to do that with new cell chemistries that keeps popping up?
I think you're off by a lot right now. Hopefully, I think what is going to realistically happen is that for new batteries, or that we have to devise some kind of battery scheme, that we not only say, okay, we have LFP or we have NCA, because you really can't generalize just over names. So you need to be able to say, if this battery reacts in this way by this, and then I can have some kind of latent embedding for each battery that I hope we can also get for new batteries that will allow us to generalize more. But I think right now we're still off by a lot.
Thank you, Laura. Please stay, and Jalal and Andreas and Andrey.
Also bring laptop if there is any online question.
Yes, very good. It's not often that you have five so bright minds at your disposal. And so please, if you have any questions, now you have an opportunity to ask whoever you want. Yes,
I have one for that. Also, I think like curious how much with varying data over time in the big strategy, how much does that affect your bidding, your capacity allocation, and how often are you like updating? Do you utilize the fact that you can forecast multiple times to update your capacity over the day? How has that transformed? Just having one time in the bid, basically.
It depends on the market. So, for example, the primary reserves, where you only have the availability payment, you can forecast pretty well for the early auction orders, earnings from that market. But then you have the and then the problem is that you kind of need to log in almost everything at the same time. Like you need to make most of the decisions at that point. So you could say we kind of, for example, for Intraday, we don't know when a good opportunity will happen. But then we look at what are some kind of features that show that in these periods, in these conditions, it's really good to have some free space to handle, so you're ready to take Intraday opportunities. But then we model that like a capacity market as well, when we compare them up against each other. So we kind of can do everything, like 24 hours before the day of operation. So you could say that we don't do that much of taking advantage of getting closer to the delivery hour, but probably I think there's a lot of potential of improving intraday trading profitability by forecasting the movement when you get closer after you already allocated capacity. And I think we will allocate more and more capacity to intraday when we go forward. Yes.
So your method based on what happened in the past in the trading there. Only the indicators of 3.17, right? So how do we come from this news?
Well, here we still get the source of uncertainties remain the same. What we can maybe say is that if the past data are the same, and if it's that the case, it means that the environment is not sufficient language. Then we'll have to decide how often we have to project historical data. So we can have projected factor, saying that what is the length of the historical data you learned from? Is it the last data of the last week, or is it of the last month, or the last year? So data scientists, they have tools to understand correlation, stationary or non-stationary. So what we can do is that all the times we have to every day update our training and see that how much we can learn from historical data. If we see that historical data, they are misleading, they are not representing the future, you have to shorten the time period you learn.
Just wondering.
Exactly.
I'm waiting for it.
Yes. This is exactly the same problem with all the machine learning community data. What data to use? In the worst, not the worst. The other option that you can do online learning, and you can every time update, and also you can add for it. But it's not.
Reason?
I had two questions.
Two questions. So first of all, it's for Andreas in terms of the 15 minutes. You can say now going from 1 hour to the 15 minutes, how will that impact the markets and how do you see the future for that and also impacting your bidding strategy? And my second question is more holistic overall. So now we had a bunch of very interesting presentations. So how, like, will all of them come together? Will you do an integration and how will you do that? Or will are they running in separate tracks? So those were.
So I'll start with the second part.
Yeah.
And we have been working together and sharing ideas in this project, but also working in each our own area. And at least in Greentech, we have a commercial solution. So whatever makes sense from this project to implement in our solution, of course, we'll be spending some time on that now. And then I'll ask the first question, which was.
15.
Yeah, I think that they already have it in Germany, so we have been doing that for some simulations on that. And if it's going to be a similar behavior, then it's going to make a big difference for the energy trading profitability. Because because of PV, you have this problem of ramping up in the morning. So for every hour, you have a deficit in the first quarter, and then you have a surplus in the last quarter. So you start getting these spreads of maybe 50 euros per megawatt hour every single hour. So that is creating a lot of opportunities. Yeah, and then for the collaboration thing, we're also discussing a lot of how we can include this state of health forecasting, and it's definitely not easy. One thing is to forecast the capacity loss, which is difficult, but then the next step is to say, what is the financial value of doing that or not doing that? And where one thing that makes sense is to kind of penalize a high state of charge, which significantly reduces or increases your calendar aging or capacity loss. But then the cycle loss is really difficult because you could take, I have this loss of capacity and I have this cost of the battery, but you already paid for your battery. So what you're really negotiating with is what is the value of a cycle in the future? Is it better to save my cycle for having it next year, or is the prices better now than they're ever going to be? That's basically the problem that needs to be solved.
I have a question for Francois. Maybe we could change slightly topic. When you mentioned before that producing hydrogen compliant to RFNBO is not trivial, so maybe I want to ask you why, your opinion, and for you that in life that you produce hydrogen with RFNBO, your opinion, how can this origin and PPAs play a role?
Yes, so it's a very tough question. I shouldn't have mentioned RFNBO. It's super complex. No, I think what is important is to realize that when you, for now, RFNBO asks for a correlation that is not strict. So that means that you need to match the energy consumption of your site with PPAs that you bought from like renewable energy suppliers. And it's not super easy to ensure that you have enough, you bought enough energy in order to supply your production plan. What will come in the future, and that we are getting ready for that, is the hourly correlation. And when I showed you all the sites that we have in direct connection, we were able at certain times, not always, to get minutes matching of the consumption between the wind farm and the electrolyzer. In terms of guarantees of origin and PPA, so I think guarantees of origin are bullshit, and it needs to be said that you can buy energy from whatever country that is not synchronized with hydrogen, and so you can just say that your hydrogen is green, although you used it on whatever carbon-intensive grid, buying guarantees of origin from another country that is not even connected. So RFNBO is a huge step toward a better accounting of carbon intensity in hydrogen. I hope I was, yeah, okay, thanks.
Thank you. I have a question for Andreas. Thank you for the very nice presentation. And I appreciate that you started with the fact that you optimize the asset level and the system of excellence. My question is about the business case. So I'm not asking about the how much, but I'm asking about the mechanism. So more specifically, do you take, let's say, X% out of each trading, or does it differ based on the market you trade on and the type of asset?
It's usually a fixed fee. So it's a combination of fixed fee because essentially there's a lot of work going on with making sure that everything is compliant and you have connectivity and like there's some manual processes explaining the customer what is FCRN and stuff like that. And then we also always have a profit share component, which I think have turned out to be quite important because then we are also motivated for telling them as soon as we see something weird and prioritizing getting it up and running again if there is a problem. And there is quite a lot of problems with benefits. It's not that mature. So even from when you buy from large like global suppliers, you're gonna see a lot of problems like at least several times per year where there is some kind of weird child disease that they haven't, like something they haven't thought of. Or, and we have moved a bit away from last year. We were more having a revenue share because it was all capacity markets. So you could say the top line was almost the same as the bottom line. But now when we are having energy trading, you kind of have to have a more complex calculation to have a profit share because your cost is also growing when you're doing energy trading. Maybe your selling price and tariffs and losses will eat up half of your earnings and so on.
This profit share stay in all markets and for all assets, or is it negotiated laterally?
It's generally like we do the multi-market optimization, so we choose the markets. So we try to align the interest and just take one cut no matter which market we choose. You could say we are really we try not to get into a conflict of interest with the customers. Oh yeah. Yeah, and
that's actually good.
Yeah, you could, for example, say there could be a conflict of interest if we go completely into heavy energy throughput services. Then we earn a lot, and then we ruin the battery in 3 years, and then the contract is over anyway. So that's also one of our arguments for having lifetime contracts, such that we have the completely aligned incentives. Something that's kind of big in this sector is kind of renting, where you rent the battery instead. And a lot of our competitors either own batteries themselves or kind of lease them. But then you have some kind of gray area because then you have some of your assets, you earn a lot more than other of your assets. And it's impossible from the outside to see who's getting the good bits and so on. So that's kind of one of our kind of key things, that we don't want to own assets because that's something we asked a lot about, especially from large scale investors.
Yeah.
Yeah, it's pretty common to own assets while also optimizing other people's assets.
I hope so.
Yeah, maybe it would have been a good idea for a while, but probably in the long term, I think it's better not to compete with your customers.
One last question. Tina?
Yeah, thank you. All popular techniques for anomaly detection for trading reinforcement learning have already been applied in stock market. I saw some papers, and my feeling is that the best techniques are not even published. You cannot find the best trading bots on GitHub. They are securely protected. But yeah, all this anomaly detection has been applied in stock market. So that's why I believe that it may be useful, because we're applying something which is already trusted and popular, but in a different context.
If you find it, will you publish it?
I will before I start trading.
Yes.
Can I ask one last one? The speaker at the beginning of the question.
Maybe it's all on.
I'm wondering, thank you very much. I thought it was too complicated for me, but extremely valuable. I'm wondering if your method could also be applied to another type of object, and I'm thinking of defining the cost of component degradation in local transformers. Could you apply the standard method to this type of project?
Yeah, I would think so.
So that leads me to the next thing. We will conclude the event here, but at least we plan to go to the Sign canteen to grab a bit to eat. And I'm sure there will be a table and a chair nearby or even next to us. So you're welcome to also come there. That's an invitation, or you can talk later. I'm sure you know each other from the area. And that's it. All that's left to say is thank you for coming.
Also people online.
And thank you online. Yeah.